Hey, what's up guys? Welcome back to the channel and I hope you're all doing well. In this video, I'm going to talk about an investing approach that's super easy, convenient, highly diversified, and best of all, low cost. It's based on a very popular index investing strategy that allows you to capture market returns through these all-in-one ETFs that provide the best balance for almost any investor. To make sure you get the full benefit out of this investing approach, make sure you watch the entire video. If you're wondering, what even is an all-in-one ETF portfolio? Then you're not alone. It's one of the most common questions I get asked all the time. The basic idea is that instead of going to a robo-advisor like WealthSimple Invest, you can use just one ETF to automate all your investing. It's a very easy and hands-off approach. I'm going to talk about how it all works in detail, so make sure you stay tuned until the end of the video. The biggest value with an all-in-one ETF is that an index investor, a passive investor, or almost any investor no longer has to worry about asset allocation with various ETFs in trying to rebalance their portfolio because of this all-in-one solution, as the name suggests. The best part, you no longer have to do any math to figure out if you're hitting all your asset allocation targets when it comes to bond, Canadian equities, US equities, or international equities. This one ETF takes care of all that for you. So that way you can take all the work out of investing, make it super automated and super easy all at the same time. You simply put all your money in one place and you let this ETF do all the heavy lifting and all the work for you. And you can put it into any account, whether it's your TFSA, your RRSP, your RESP, or even a non-registered account. While there are many asset managers that offer these all-in-one ETF solutions, I'm going to focus on Vanguard for the purpose of this video because they're considered to be the pioneers when it comes to index investing. However, I will give you some alternatives along the way so you have plenty of options to choose from. In a nutshell, you want to think of these ETFs like a really big umbrella with various types of ETFs sitting under its shade. Vanguard has 6 different offerings when it comes to these all-in-one ETFs. And in this video, I'm going to help you decide which one makes the most sense for you and your portfolio. By the way, if you're new to the channel or you've seen my content before, do me one huge favor. Hit that like and subscribe button. It does 2 things. 1, it lets me know to produce more content like this. And 2, you don't miss out on future ETF picks. While all 6 of these all-in-one ETFs are very similar from Vanguard, I'm going to use the ETF VGRO or VGRO to explain how they work and then talk about the differences between the other 5. At its very core, VGRO and these all-in-one ETFs in general give Canadians a quick and easy way to invest for the long term. The asset mix for VGRO is tilted towards the riskier side of that risk/reward spectrum, with 80% of your money being invested in equities, also known as stocks/shares, and 20% being invested in fixed income, also known as bonds. Now that may sound confusing, especially if you're new to all this. So let's say you were to invest $8,000 into this ETF. Where does your money go exactly? It would be automatically split into the following ETFs. 33.2% would go into US equity, 24.4% will go into Canadian equity, 16.6% goes into developed markets, excluding US and Canada, so your money goes to places like Japan, the UK, France, Germany, etc. 11.6% goes to Canadian bonds, 6.2% into emerging markets like India or China, 4.5% goes towards international bonds, excluding US and Canada, and 3.5% goes to US bonds. Now within those ETFs, you'll find names like Microsoft, Apple, Google, Facebook within the US ETF. You'll find names like Royal Bank, Shopify, TD within the Canadian ETF, and you'll find names like Nestle, Samsung, Toyota within the developed markets ETF. As you can see, this all-in-one ETF like VGRO has multiple layers. It has geographic diversification, meaning your money is spread across North America, South America, Europe, Asia, developed markets, you name it. And you also get company diversification, and your money is invested across a diverse group of companies across multiple countries. That's why I love this ETF and wanted to share it with you because you get almost everything in one package. It's very convenient, very easy. But VGRO doesn't just stop there. Yes, you get exposure to over 13,000 companies worldwide, but at the same time, you also get exposure to over 17,000 bonds across the world, across many maturities. You get government bonds, you get high-grade corporate bonds, and a variety of bonds in between. The point I'm really trying to make here is that with just one ETF, you get exposure to thousands of companies, thousands of bonds worldwide in just one package. Worldwide investing has never been so easy or accessible until now. Not bad for maybe about 90 seconds worth of work. From logging into your brokerage account, typing in that ticker symbol like VGRO, and hitting that buy button. It's that simple and it's that easy. If you use WealthSimple like I do, buying and selling these all-in-one ETFs is completely free because they trade in Canadian dollars. They trade on the TSX, so you can invest in the entire world right from home. If you have not set up a WealthSimple, make sure to check out this video where I walk you through step by step on how you can get started trading stocks and ETFs for free with zero commissions and no trading costs. And as a bonus, if you use the link in the description of this video to sign up and add money to a non-registered account on WealthSimple Trade, you're going to get the cash equivalent of 2 free stocks worth anywhere between $5 and $4,500. This is a brand new promotion from WealthSimple, so make sure you take advantage of that offer and don't miss out on 2 free stocks worth up to $4,500. Now you might be thinking, but Danish, what if I don't want exposure to bonds? Or you might be even thinking 80% is just too much exposure to equities. What if you want more bonds? Vanguard has you covered. No matter where you land on that risk/reward spectrum, there is an all-in-one ETF solution for you and your profile. The ETFs that I'm about to list are very similar to VGRO that we just looked at. The only thing that's changing is either you're increasing your exposure to bonds and less equities, or you're increasing your exposure to equities and less bonds. The makeup and diversification of these ETFs is also very similar. You still get worldwide exposure. The only thing that's changing is the percentage split between equities and fixed income. The first option is VEQT. This is a 100% equities ETF spread across Canada, US, developed and emerging markets. This is the highest risk and reward option out there. This is also known as the all equity portfolio. The next one is VGRO, as I just discussed. Less risk, less reward than VEQT because it gives you 80% exposure to equities and 20% to bonds. This is known as the growth ETF portfolio. The next one up is VBAL. This is 60% equities and 40% bonds, also known as the balanced ETF portfolio. Next, VCNS, 40% equities and 60% bonds. This is known as the conservative ETF portfolio. Next, VRIF, 45% equities and 55% bonds. This is known as the retirement income ETF portfolio. And last, VCIP, 20% equities and 80% bonds. This is known as the conservative income ETF portfolio. Let's take a look at their performance. The ETFs have an average annual return since inception between 6 to 15%. The higher the equity exposure, the higher the potential return. Take a look at VEQT in particular. This has the highest return since inception because this is a 100% equity portfolio. VCIP, on the other hand, has a lower return because it's 80% fixed income or bonds. One thing I want to highlight is that when you take a look at an average return since inception for these ETFs or any other stock or ETF for that matter, past performance is not an indicator of future results. Meaning, even though these ETFs have delivered some great returns in the past, it does not mean they're going to deliver the same return going forward because we don't know how the markets will perform in the future. No one knows that. You can only look at the history for guidance and as a ballpark measure. Now, as great as these ETFs sound, let's take a look at fees. How much is it going to cost you to hold on to these ETFs? When we're comparing these all-in-one ETFs versus other ETFs, the acronym that you want to understand is MER. MER stands for Management Expense Ratio, and it's typically a percentage between 0.05% to 3%. To understand how much an ETF is going to cost you to hold on to each year, you simply take that percentage and multiply that by the amount of money you have invested in that ETF. The lineup of these Vanguard All-In-One ETFs all have an MER of 0.24%. Another way to think about this ratio is that for every $1,000 you have invested into these funds, it's going to cost you $2.40 per year. This money does not come out of your pockets directly, but rather the total return of these ETFs is reduced by the MER. You can see that there is so much benefit in going to these all-in-one ETF solutions because you don't have to hold on to anything else. You simply buy more of whatever ETF makes the most sense for you. Your entire portfolio can be made of just one ETF. Yes, your entire portfolio can just be one ETF, leaving you with plenty of time to do whatever else is happening with your life because now you have an automated, passive approach to investing in the entire world. But having said that, there's potentially one more benefit of having this automated investing approach. I've been doing this investing thing for the last few years now, and I've spoken with many different investors from all different walks of life. And one thing is clear, human beings are generally pretty good at sabotaging their own investment returns, even after they commit to being passive index investors. In the day of modern ETFs, you're going to be constantly bombarded with new ETFs and new offerings. There is constant temptation to bet a little more on your home country stock market, on the international stock market, on the US stock market, on the emerging stock market, or even on that next meme stock. There is plenty of temptation to go around. Based on all the research and studies I've read, the average passive investor earns 50% less than their ETF or mutual fund have returned over the last 10 years. Seems crazy, right? How can you earn less than your ETF performance if all you have to do is just hold on to that ETF and just ride it out? The problem is exactly that. Instead of keeping things simple and easy, investors try and time the market. When things are going well, the news is reporting that the stock market is doing great, investors plow their money into these ETFs in the stock market. When the news reports that the stock market is crashing, investors get nervous, and people either invest less, sell their funds, or go all in cash, or decide to invest in something that's just doing better in that moment. This is a form of market timing by going in and out of ETFs based on the news cycle. The result of this strategy is that you end up buying the most when the market is at its peak or approaching its peak, and end up buying the least or even going all in cash when the market is approaching a low point. In effect, you're buying high and selling low. That's the exact opposite of what you should be doing. These all-in-one ETFs take that temptation right out of your hands. This might be one of their most valuable features. All you have to do is keep things simple and easy. Don't overcomplicate it. Come up with an investing plan and just stick with it. If you're going to invest every time you get paid into one of these all-in-one ETFs, then just stick to that, regardless if the market is up or down, because in the long run, you will come out ahead. As I mentioned earlier in the video, there are alternative all-in-one ETF solutions from other providers. If you don't want to go with Vanguard, take a look at this chart. You'll notice that in addition to Vanguard, iShares by RBC and BMO all have their own offerings of these all-in-one ETF solutions. VRIF is a relatively new offering from Vanguard, having launched within the last 12 months. This ETF is a little bit different from the other ETFs. Even though it has a 50-50 mix between equities and bonds, VRIF is a little bit different compared to the other all-in-one ETFs, as it seeks to target, but not guarantee, a 4% annual return for retirees. Vanguard is considered to be a pioneer when it comes to index and passive investing. There are other providers that offer similar ETFs to that of Vanguard, and I wanted to point that out for you. Notice how most of these other offerings use a ticker naming methodology that's similar to that of Vanguard. While the tickers are similar in many cases, the asset allocation of these ETFs may not be identical. And this is something to think through if you are considering one of these alternatives. Not every ETF has an identical alternative, but it does give you options to consider. Thank you so much for watching this video. This channel would not exist without your love and your support. So please do me another huge favor. Check out the links in the description of this video. I have offers to various discounts and sign-up bonuses, and to other content outside of YouTube. Every click directly helps support the channel. Do you have questions for me? Feedback on this video, or maybe you have ideas on future content? Let me know your thoughts in the comments. And while you're at it, make sure you hit that like and subscribe button. That's it for now. I'll talk to you in the comment section.